Hello and welcome to Beginning Budgeting for Small Business Owners. This is Polly Mertens. I appreciate you being here, and I'm pleased to present this topic on behalf of Mission Community Services. This recording and this webinar are for small business owners, specifically who either it's been a while since they've looked at financial statements, or they're very early on. Let's say this is an introductory level course about small business budgeting, and specifically cash flow statements and income statements. So if you're listening to this and you are very familiar with income statements, cash flow statements, using them in your business actively, frequently, this webinar would probably be more basic and beginning level for you. So just wanted to point that out. If this is something that's new for you, or you're not actively using it in your business, then this is a perfect opportunity for you to maybe either get some retraining or learn it for the first time. So with that said, we'll get started. So first, our learning objective. So if you visited Mission Community's website, you saw this as our learning objective. It's very elementary, but it's very important. So we want to help you learn how to set up and use two of the most important financial budgeting tools in business. Whether you're a small business or you grow to be a large business, all businesses can and should be using these two tools to run and manage their business. So they're the profit and loss and cash flow statements. So that's the objective, is to help you understand what they are. If you've never seen one before, you're going to see a couple of examples today, and then know how to create them for yourself. So our agenda starts with introducing you to some of the financial terminology. And as a woman who has both attended college, I have a master's in business, an MBA, and got out of college myself, never having actually seen some of the terminology or understanding it quite the way that financial people talk about things. So I just want you to know that financial terminology is not designed to confuse you, but I'm afraid it does confuse a lot of people. So I want to touch upon some of the terms and kind of break some myths or misunderstandings that people have, just to help you get more comfortable with these, so that you can feel more confident as you speak with people in the field about these, what these different terms mean. And then we're going to go into a 12-month profit and loss projection and show you what that looks like, steps to preparing them, and a couple of examples. And then we're going to go over the cash flow statement. So why prepare a cash flow projection, and then the step-by-step how to prepare them. So let's get started. So financial terminology. This is, some of you may be familiar with this. Some of you may have seen these words and never known, are they the same thing? Are they different? So I just thought I'd put a couple of these up here for you, because as I got more and more comfortable and familiar with these, I realized these people are saying a lot of the same thing, but they're saying it with a lot of different words. What is going on here? And so if you're in that boat and you felt somewhat confused at times, let me just help you understand where some of these things tie in, and they relate to the same thing. So we're going to be talking about today, one of the worksheets is called a income statement, which is the same thing as a profit and loss, or P&L. So if you've heard the word P&L and you've heard the words income statement, they're the same thing. So profit and loss, P&L, income statement, all talking about the same document. And I'll share with you what that looks like here in a moment. Cash flow statement, or statement of cash flows, CF, sometimes people refer to it as an IS for income statement, or a CF for cash flow statement. Same document. Revenue, sales, and income. Another three words that can often mean the same thing. And you have to be careful, because sometimes when you get down into net things like net profit or net income, some of the things can become a little bit different. But oftentimes you will hear revenue, sales, income. They can often refer to the same thing. So if you've seen that in different places, I will refer to them interchangeably. Those are often referring to the same thing. So for example, you'll see gross revenue, gross sales, gross income, same numbers we're referring to. This one has a little bit of a caveat, but I'll explain it. So expenses are costs, two ways of saying the same thing. Now, when we quantify that with overhead, typically we mean fixed expenses or fixed costs, those costs that don't vary with the amount of sales in your business. So something like, for example, rent would be the same. Oftentimes overhead on The utilities might be the same thing, or you pay perhaps the same amount for insurance, whether you sell 500 units or 5,000 units. That's an example of overhead. Expenses, costs, overhead, often used interchangeably. I would refer, most often you'll see in these documents, people referring to it as expenses, but I just wanted you to know costs and expenses can be interchangeable. Cost of goods sold, or COGS, as it's sometimes referred to. Another way of looking at it is your inventory. So businesses that sell goods, so not services, like a service business, for example, an attorney or an accountant, they often won't have inventory, a physical product that they sell. But those of you who sell a physical product, a widget, t-shirts, mugs, coffee, whatever it is, cost of goods sold, or COGS, is referring to the cost of the inventory or the products that you buy to resell. A chart of accounts, and you won't see this again in this document, but I wanted to just give you that word so that when you go to talk to your accountant or you go to talk to your bookkeeper, you ask them for the right term and you speak in the right terminology. So a chart of accounts is largely the way of categorizing if you looked at, and we'll look at here in a few moments, the cash flow statement or the profit and loss, the items on the left-hand side. So it's the categories or the buckets that you put expenses or income. It can refer to categories of income. So if you have multiple streams of income coming into your business, you could have rental income, for example, you could have sales online, different ways that money is coming into your business. The chart of accounts will say ways of putting buckets to the different forms of income that you receive, and the same thing with expenses. So rent would be one item in your chart of accounts, utilities, automotive, transportation, things like that would be showing up on your chart of accounts. So when you want to create this document, when you want these documents created for yourself, if this is the first time you've done this before, it's really important. It's much like when you go to organize your files. You need to decide, how am I going to organize this first? What buckets am I going to put my expenses or my income into, so that at the end of the year or at the end of the month, when I want to create reports on this, what do I want them categorized in, or how do I want to see them? And the more complex your business is, the more chart of accounts or the more micro divisions you may have within that chart of accounts. The word pro forma is a fancy word for projection. I just wanted you to know, if you ever have someone in business try and throw that word at you, it means a projection. So a pro forma chart of account, a pro forma cash flow statement is just saying, what's the projection of cash flow? So with that said, if you have any questions, as I said in the beginning, please feel free to hold on to those, or if you're listening to this live, you can go ahead and chat that to Nicole in our little chat, and we'll answer that at the end. But any questions on the terminology, please, I welcome them. And on we go to something I wanted to share with you about business owner mentality. And this is something that I realized after going into business for myself, coming out of college, even a graduate with an MBA. College accounting was for the controller, not for the business owner. And if you've never taken college accounting classes or any accounting classes, then just know that those of us that did, we were taught what was called debits and credits largely. So I was consulting with a new business owner here at Mission Community Services, and I said, let's prepare your income statement. And she goes, okay, I'll get the debits and credits. And I had to remind her that that was for the controller of the business, and that's how they keep track of things. But cash flow and income statements are how we as business owners run the business with the appropriate statements. So historical and projection statements are valuable, so for different reasons. So historical reflects the actual business activities. So oftentimes a P&L, an income statement, is showing you where you've been. So most often, if you go to your accountant, or if you're working with a bookkeeper and you bring them all of your expenses, or somehow you guys are working collaboratively in QuickBooks, and you ask them to prepare an income statement at the end of the month, it's actually showing you what has happened in the business. Pro formas or projections are valuable for looking into the future. So it's an estimate of future business. You can have P&Ls and cash flow statements for projections into the future, and it helps you identify where you're going. We'll talk about that in a little bit here. I recommend you look at your historical, your P&L every month. So if you are currently in business and you have never done this, one of the things I wanted to say is that Mission Community has a great host of counselors here If after this webinar you feel like you want to get started on this, or you've maybe dabbled in it, or you're starting to create your projections, or you're trying to run your own P&L, you're not working with a bookkeeper, you're doing this on your own, please reach out to Mission Community if we can help you in any way. We have great counselors that would be happy to help you set up a chart of accounts, help you look at your P&L, see if you're doing it correctly, and then help you evaluate it and help you better manage your business with your P&L. I would recommend that you look at cash flow projections as needed or every 6 months. This is really individual to businesses. Some businesses are very seasonal, so it makes sense for them to do perhaps a 6-month or 12-month forecast, so they're really keyed into the ebbs and flows of their business. And I encourage you, one of the things that helped me as I started to understand the financial terms and terminology is I felt a little more educated and a little more informed, so that when I went and talked with my bookkeeper or CPA, I started to understand their language and could ask them for things and ask questions. So oftentimes in finance and numbers and, as a new business owner perhaps, or, maybe you've been in business for a while and you've just never really created these documents, you felt intimidated. I want you to get over that. I really want to encourage you. The more I began talking with my CPA and my bookkeeper as they were preparing things and asking questions of how this works and where this came from, especially at year end, which a lot of you are doing right now, it's important. So be engaged with your bookkeeper or your CPA and have them help you, make sure as you're setting up your chart of accounts, if you're doing this for the first time, ask them questions. Stop being stumped by being intimidated with finance. Just jump into it. Okay, so let's get started and have a look at a profit and loss P&L and an income statement. So what I've got here are 2 examples, very rudimentary, very simple. I want to help you start to translate if this is the first time you're seeing an income statement. So on the right-hand side, we have a business income statement. So this is an income statement that has it's a rolled up high level income statement. On the left, I've just created an example of perhaps a personal income statement. So you can see how they in some way align, because I think if you can start to translate like, oh, I understand, I've done budgeting at home. I know how to articulate what my expenses are and keep track of them so that I know what my take home pay is or what I can invest or donate. You'll start to see that with a business, it's similar. It can be much more complex, but it's very similar if you can get your head around it. So if you look at the left-hand side, a personal income statement, we start with, let's say you have a job. This is just an example. If you have a job, first you have your taxes taken off the top. This is how, if you work on your own, taxes are taken off right off the top. And then your personal expenses, so these are your personal, let's say home or household expenses, you would list those below. And let's say this is an annual income statement. You take your gross income, reduce it by your personal expenses, and you're left with your net income. If we translate that over to the right-hand side, for a business, we start with our sale. I'm using all 3 of them here you see together. So we have sales, income, or revenue. We start with our top line revenue or sales. We subtract our cost of goods sold, and this is assuming a business that has goods or inventory or products that they sell. Then we're left with a gross profit or gross income or gross revenue number. Subtracting from that, we lump this together. So what makes up selling and administrative expenses, the next line item here, is a lot of subcategories. So in that chart of accounts, there may be many, many things that go into this. But as I said, I just wanted to start you off with a very introductory look at what an income statement looks like. So we reduce the gross profit, taking away selling administrative expenses, and we're left with net profit. We take away taxes. So in business, you deduct your expenses first, and then you're taxed on what's left. That leaves us with net income. So our net income at the end of this, let's say 12 months, is what either the business owner takes home, if that's theirs, or is reinvested into the business, or the partners take home. So that's a very simple one. So a profit and loss and income statement shows profitability of the business, how well you're managing expenses, and the markup on inventory. So it's designed to show you, is the business profitable? Is it making money? It's prepared monthly, quarterly, or annually. You can do it every month and every quarter, or just once a year. I absolutely recommend that you be looking at your P&L at least once a month. It includes non-cash transactions. So this is where profit and what we'll see in the cash flow statement are different. So non-cash transactions, so an example of that, there aren't many in the world, but there are things like depreciation. I'm not going to go into that in depth, but just know that depreciation is not a cash transaction. It's a non-cash transaction, excuse me. So this deducts from our profitability. It includes future values. So a profit and loss statement or an income statement can include things that we expect, like accounts payable and accounts receivable. So money that we expect people, we've invoiced them and they have 30 days to pay. And things that we buy on credit. So our accounts payable, things that somebody has given us, say 30 or 60 days to pay. And what you pay taxes on is included, basically an income statement is what you pay taxes on, and it's showing your expected profits. And I say expected because things happen in business. Sometimes people return products, or they default on their receivables. They don't pay you when they say they will, or they fraud on their credit card, things like that. So a P&L is an expected profit. It's not necessarily the cash in and out of your business or your bank account. Big distinction there. So why create a P&L? Why would we want to do this? If you're not doing this, you're sitting here asking yourself, well, do I really need this? People talk about it, but why would I create it? Profit and loss statements help you track your goals, your profitability. It's also motivating. It shows you, wow, these are our goals, and you can see it. So maybe you say, oh, I want to grow my business by 20% this year. But when you see what that looks like, and you can see at the bottom line, and you'll see in some of these projection statements, we'll look at it in a minute, wow, that means I have this much income coming in, or, that motivates me to expand into that business. P&Ls will be asked for when you're considering borrowing money. So if you're going to try and grow your business with borrowing money from an outside source, or you want to expand and you need cash flow to do so, most sources, most public, private money will require P&Ls. They want to know, okay, how are you going to repay this? So a P&L, an income statement, is a great way for the bank to see your projections, both in the future and then historical. They'll want to see, okay, what has your business done, say for the past 12 months, or perhaps depending on the size of the loan, the past 5 years. It can help you determine areas for improvement. So what you'll see on a P&L is profitability. How well are you doing marking up your inventory and managing your expenses? How profitable is your business? And you can see sometimes when you either do projections, or if you aren't currently looking at your P&L, what your business has been doing historically, and say, wow, expenses are really out of control. No wonder we don't have a lot of cash. No wonder it seems we need to, cut costs here and there. It's helpful for knowing the viability of new ventures and products. So performers and projections help you say, gosh, I wonder if we should do that, add an extension, a new line of services, or I wonder if we should go into the online business with our products. So what you can do is take your goals and your set of assumptions about what this new venture or this particular product line will look like, and translate it into actual financial numbers. So you can make not only a gut level decision like, wow, it really sounds like this could work, but when you actually run a pro forma on your projections for cash and profitability and how many we could sell for this, you can make a much more informed decision like, yeah, this could really work, based on these assumptions, of course. And a P&L predicts the income or amount of reinvestment for the owners. So it's a great way for you as an owner. I had a meeting with a client here recently who had not been doing P&Ls for her business for 5 years, and she knew that she was losing money, but she didn't know how much she was losing. She didn't know where she was. And so I suggested to her first meeting is you need to do a P&L immediately. So, like bottom line, where are you? Where do you stand? And then looking forward, is your business expected to be profitable in the future? If not, you need to either look at ways to turn the business up, reformat it, get some loans if you need to grow it, expand it, advertise more, whatever it is. But it helps you as a business owner know, am I losing money? Am I making money? Is this worthwhile? And if you're considering starting a business, a P&L is absolutely a necessity so that you can get some justification for yourself whether you should go into this business. I've looked at many businesses in the past. I've done pro forma, both business plans for them and then pro forma financial statements. And I've not done those businesses because as I projected out with my set of assumptions of what the sales would be and what the expenses would be, that it just wasn't profitable enough. It didn't make sense to invest in that business. So one of the questions you may have is, well, if you've done these before, it's like, or if you've not done these before, well, how do I start to create a profit and loss? Where do the sales and expense numbers come from on this? And I'll show you what the P&L, a more sophisticated one looks like. Where do we get those items that go into those buckets, those chart of accounts? And as a consultant and having seen this in a lot of businesses, there's several sources that you can get this from. And there's no perfect way of doing this. So I don't want you to think that you can do this wrong. You want to make as sophisticated and educated assumptions and planning as you can, think things through. But, whenever you're forecasting things in the future, it's not a known. So sometimes we look at our crystal ball. One of the answers here is you guesstimate. You literally say, well, I've never done this business before. It's never been done before. That's the most risky or most assumptive business you can start, is one where there is no historical means to look upon. And so the first one is, if you are in business, you can look at your historical, and oftentimes businesses will take the numbers that they did last year and mark it up as a percentage. Well, we expect to go 3%, 10%, 20%, depending on the stage of the business and what they're forecasting for advertising and growth and what the market is doing. And other similar business owners and industry trade reports can be a source for you. So oftentimes when consulting with people looking to start businesses, other business owners can be a source of sounding board for you. They can give you an idea of maybe what their profits are like or what their sales are like, so that you can draw upon some of their experience in building your own assumptions and your own conclusions for your business. And when I say other similar business owners, oftentimes I'll recommend, let's say someone starting something like a coffee shop. And I say, okay, well, you can start that coffee shop here in town. Why don't you contact 3 business owners in similar sized markets, similar business model, similar selection of product, let's say, and ask them about their business and the viability of their business and how sales have been doing in the past and present and what they're forecasting. Have a conversation. Business owners are often you would be surprised how much they would share with you if they see you as a colleague and not a competitor. So if you're going to open up a business in your town, contacting other coffee shops in your town probably isn't going to work, but in other towns it could. And there are lots of information available on the web. Your local library or your university library, if you have one nearby, can often be a great resource. Industry trade reports, including financials, projections, or industry averages are available. I've oftentimes sent clients to the local university because they have access to huge databases, very expensive databases of information that perhaps the local library may not have. University libraries often have very, robust subscriptions to things that you or I would pay a lot of money to have. Going to the reference librarian inside of a university library is often a great way to get those industry or trade reports in your particular industry, whether you're starting a new business or in your existing one. I like this last one. So investigate and research. So part of the third one there is the guesstimating, or asking other similar business owners. Investigating. So, some of it can be things like surveys. I've done surveys of people in related businesses or in the local market. This is your market research data. Some of it can be qualitative data gathering. So you're asking people, hey, would you mind taking 3 minutes for this survey to tell me, would you use this business if it were started in this area or online? Would you be interested in this particular product? How much would you value it, et cetera, et cetera? Giving you some information, trying to capture some data wherever you can on what the sales potential is for that product or that market that you're trying to introduce. And then expenses. So oftentimes clients will come in if they're looking to start a new business. Let's say they want to create something that has a storefront. They need to actually go out and make calls and research and find out, what are business licenses cost in their area, what do rents on square footage, contact contractors, find out what construction costs may be to renovate or build out their space, et cetera, and on and on. So it's gathering information wherever you can and as much as you can, as much as the hard data that you can get, the better your numbers would be and the more you can rely on those numbers. So industry and trade reports are often, let's say, very generic. They're very averaging. So your market could be dramatically different. If you're in a smaller town or a bigger town, you may have very vastly different numbers than, say, an industry trade report. They'll give you an idea of what to expect, but they won't be based on actual. So the best way to find out is making local calls, doing actual research on your particular needs. So preparing a profit and loss statement for the first time, and this will vary depending on if you're working with your CPA or if some of you can do this, at least very elementary just to get started in Excel. It doesn't have to be super sophisticated. I'm going to show you a resource at the very end. Score has some online templates that you can use. So you start with sales. And as I said in the last slide that we just looked at, estimating sales comes from a variety of places. You can do online surveys, you can do in-person surveys, contacting owners of other businesses, trades. If you have a business partner or if you have a collaborative team, coming into Mission Community Services for some advice. Maybe we have resources from other business owners we can connect you with. It's all about sitting down and sometimes it's fundamentally building it from the ground up. If I started this restaurant and I expected to have a busy lunch schedule, that could look like we would sell this many plates of salad or, chicken breast or whatever it is. And we would do that for 5 days a week, and you extrapolate it and you build it upwards. And again, sometimes you do it on industry averages. So you say, well, the industry average for an attorney is making X amount of sales. I expect, because I'm new in this field, that mine would be 50% of that, however it is. So lots of ways, but it starts with estimating what could my sales in this field be. Step 2 is estimating variable cost, the cost of goods sold. So for those of you that are selling products, this is a great way and a great opportunity for you. If you are selling another product, you already know and you've identified what those products are. Depending on how far along you are in your planning, early planning, you may just want to do broad brush strokes. So you may want to take some industry information on terms of, the average cost for, let's say you're starting that coffee shop, the average cost for coffee and cups and swizzle sticks and sugar packets and things like that. So estimating those variable costs, those things that go into producing that product, or if you're selling t-shirts online or at events or something like that, you start to gather some data based upon, let me do some research on how, what wholesaler could I get to sell this particular product to me, and get as best you can an estimate of those. And then you roll those up into your total variable costs. So you take your estimated sales, you take your estimated variable costs if you're selling a physical product, and that helps you calculate your gross profit. So your sales minus your cost of goods sold will give you a gross profit number. So that's how much you're basically making on reselling those goods. And then we need to estimate expenses and taxes. So expenses are particular to that business. So as some of the things that we've mentioned here a little bit earlier in terms of, okay, some of my overhead. So what are my fixed expenses or things that I expect to take place in that particular period? So if you're doing a 1 month P&L, or if you're doing it in, let's say, a 6 or a 12 month, okay, what expenses can I expect from each of those different chart of accounts, each of those categories: advertising, salaries, rent, insurance, transportation, things like that. And then calculate all of that. And then based on that, what are the taxes that will pay for that? So sales minus cost of goods sold gives you your profit, deduct your expenses, and then deduct your taxes. And you're left at the end with gross profit. Your net profit, excuse me. So gross profit minus expenses. I'll show you that here in just a moment on the next slide. This is a little bit more sophisticated look at an income statement. There are some things here that I'm going to broad brush stroke, but I just want to give you an idea of what an income statement, a little bit more sophisticated than that first one that I showed you, could look like. So we have here on the upper right, we have our sales. So in this particular business, they bring in $660, it looks $660,000, it looks like, for the products that they sell. They have some discounts, returns and allowances. So their total cost of goods, less things, for example, returns and allowances are, maybe there were some damaged goods, maybe there were some people returning things that didn't work out, or they opened it and it didn't work for them. So their net sales was $653,000. Now, when you get down to cost of goods sold here, we're taking in beginning inventory. So this business has been up and running for some time. So their beginning inventory, for example, is based upon actually what was in inventory on December 31st. So they're starting with, this is an ongoing business. So we're starting with $120,000 in inventory when we start. They, over the course of the year, because this is for the year ending, they purchased $230,000 worth of inventory. They have freight costs. So they take this $120,000 plus the $240,000. In this particular example, there are some discounts. Maybe they got some discounts on, maybe there was a sale on some of the goods that they were purchasing. But they did need to return some things. So they didn't actually sell all of that 230. They only took in and took responsibility for, say, 234,000 here. So that gives them $354,000 worth of inventory or goods available for sale. They, at the end of the year, had $71,000 worth of inventory left. So at the beginning of the year, they started with $120,000. They had $71,000. So the difference is this $283,000, excuse me. So $283,000 was what this business, so to make these net sales of $653,000, their cost of goods sold for that inventory, the difference was $283,000 worth, leaving them with the gross profit of $370,000. If we look at what they categorize as their selling expenses, and I just wanted you to see sometimes how these can be broken out. So selling expenses, so this is the advertising, some freight out, maybe they had some samples, things like that. Depreciation, utilities, salaries, maybe the salespeople. Altogether, selling expenses were $142,000. Maybe they, some of this could have been broken out into some events, things like that. $70,000, depending on the size of the business, could be a sizable chunk of money. So we're not sure. This here is their chart of accounts. So this on the left-hand side is this particular business, how they break these out. Some businesses might break advertising down into subsets further. So you could see things underneath advertising or underneath, let's say, a promotional expense. That could include events that they attend, printing that they do, actual advertising in terms of print magazines or online advertising, Google pay-per-click, whatever it is, their website. But in this simplified version, they've rolled that up into advertising. Utilities, there's not just one utility. They probably have 3 or 4 or 5 different buckets that roll into this utility category. And then salaries that might be broken down into managers and full-time or part-time employees. But this all rolls up here nicely. So we have $142,000 of what they're categorizing as a selling expense. They've broken that up separately from general and administrative. So these salaries here, as they vary from these salaries, might just be, these are the salespeople. The salespeople are the people that are actually involved in the selling of this product, as opposed to these salaries might be more of the administrative people. Maybe it's the bookkeeper, the receptionist, administrative assistant, general manager, things like that. Depreciation, this has to do with oftentimes equipment. We have another utilities cost here. Insurance can vary. There might be several forms of insurance here that they're lumping into this category. They're putting rent as a line item here. So they're calling their general administrative costs or expenses at $170,000. This is pretty unusual, but in this particular example, they had loss on the sale of land. So we won't often see that in most businesses. So we'll just skip that. But interest expense, It tells me that this business has some debt, some loans that they're carrying. Perhaps it's on this equipment or this machinery that they've purchased. So they've got interest expense or loans. And so we've got here the cost for that. So we take all those costs, we get 300. So we take 142, 170, and 9,000. We have 321,000 of expenses that they're taking into account. So our gross profit. So here are the buckets. Like if we look at our really simple one earlier, we have total sales, net sales, costs of goods sold, 283 gives us our gross profit. We reduce it by our expenses, general and administrative, 321,000. We're left with 49,000. That is a taxable income for this business. We take in what the income tax is for that amount, and we're left with 39,000. So this business's net income is $39,000. That could either be divided between and in some cases, the salary may include, the owner may put their salary up in here. Sometimes the owner may take it out from net income at the end. It depends. This may be distributed to shareholders, however you want to look at it. So that's a pretty simplified, rolled up version of what an income statement would look like. I want to transfer that. So this is not the same business, but just wanted to give you an example of, okay, so let's say this was an actual statement for the end of the year. This is what this business did over the course of 12 months. It could be a projection. This might be a business projecting this is what they'll produce and what the net income would be. But you could also look at it, this is what the business did do. So at the end of the year, this is what they're reporting. A pro forma P&L or 6-month pro forma P&L often can look like this, where it's month by month, for example. And you can see this in a 6 or a 12-month pro forma. And what we're looking at is pretty much the same idea, where we start with sales, we reduce expenses, we have our taxes, and we're left with a net income. And if there was a negative number down here, we'd see that this business was operating at a loss. Looking at this, it shows that this business, because these numbers are all positive, is operating at a profit. Maybe not a large one, but we look here, sales aren't tremendously large. So this is, we don't have in here, we've got payroll taxes. I don't see salary in here. So this would be basically the net income to the owner, for example, or the owners. So what someone who is doing a 6-month pro forma is doing is anticipating, okay, looking out into the future for the next 6 months, let me forecast what I anticipate sales to do. And as you can see here, this business, as with all businesses, has some fluctuations. It looks like in the beginning of the year, first 2 months of the year, pretty consistent, and then it drops. So this business expects, either from historical experience or from just knowing cyclicalness of the type of business that it is, that its sales could see a dip pretty significantly. This looks like it's about 2/3 of the sales in the other 3 months. Supplies, looks like these numbers correspond. So labor goes down, supplies go down along with it. Gross profit, as you might expect, also declines. And then we look here at more of our fixed expenses. And even though we have fixed expenses, something like rent, utilities, telephone, actually this particular one, they're lumping all three together. So while we might expect rent to be unvariable, adding utilities and telephone could give some variation. So we are seeing that. We're not seeing as big of a decline here. So it's clearly not reducing when they have a dip in sales. It's not reducing their expenses very much in these three categories. This one, it drops some, a little bit of a drop here in office supplies. And looking at this, what this particular person may have done is just taken a percentage when they've calculated these numbers, well, except for this one should be the same if you expect your loan amount to be consistent and amortization of some debt. They might have just taken percentages. They might have just taken 70% of whatever these numbers were and carry that forward. One way of doing it, as long as you're looking at these numbers and saying, okay, that's valid, that's pretty valid. No, this number is actually going to go up because of X, Y, or Z, whatever it is. a number that you often see varying, and I don't see here in this chart of accounts, is advertising. So I'll show you another example when we get to the cash flow, where you'll see advertising can vary quite substantially when you have payments for things like, let's say you have a deposit for holding space at a trade show or at an event. You could have a big chunk of money going out in one month that doesn't go out in other months. This one is pretty flat, pretty similar. This might be a business, for example, that doesn't have a lot of variability in terms of their costs. They know what their costs are. They've got control on these costs. So bottom line, this is just what a pro forma would look like. So whoever is running this, they could look at this and say, okay, is this is this a business that I want to continue to manage this way? Is making $300 worth my time, my energy, my staff, my risk, putting this money on the line, for these larger months where you have, $1,800, let's say, is that worth it to me? Is that what I need to be taking home? And if not, we need to be looking at the sales numbers, and we need to be looking at these expenses to see either we need to increase sales without a marginal increase in expenses, or we need to cut our expenses so that we can increase our net income. So that's essentially what a 6-month pro forma would look like. I often recommend people starting in business, and you'll see lenders ask for, at least a 12-month pro forma P&L if you're looking to borrow money. Let's shift now to a cash flow statement. This is very simple version of what a cash flow statement would look like. I just wanted to give you an idea, very high level, what we're talking about, and then I'll show you a little bit more sophisticated, a lot more sophisticated one. But I wanted to allow you to get your head around the idea of what a cash flow statement is designed to do and how it's different from a P&L or a profit and loss. So a cash flow statement is designed to show you the flow in and out of your business and what you're left with of cash. So this would be almost like if you receive personal bank statements at home anymore, a lot of people do them online, you'll know that your bank often tells you, this is how much cash you had in your bank account at the beginning of the month. These are the checks that you wrote or the withdrawals that you made. These are the cash deposits that you made. And here's your closing balance. So that's what a cash flow statement essentially is. It says, okay, either in a forecast or historical, what cash did we start with? What cash came in? What cash went out? And how much are we left with? And if you look at this, we can see in January, we started with 3,000, took in more cash than we had go out. So we're left with a bigger number. The reverse of that is true in February. We take in more cash, we start with more cash than January, we start with more cash than we did in January. We don't have as much coming in and we have a big cash outflow. So we're actually left with a negative number that carries over to the balance for the next month. So I ask you to think about what would it look like if you had a negative cash balance as a business one particular month. So we'll go into a couple of examples here in a moment, but what this tells me is something hit a loan or a credit card, because unless you have the cash to cover this outflow, so you're paying for some sort of expense, you're buying something during that month, money is going out of the business and you're left with less cash, unless you have a resource. So if you only have $5,500 and you have to spend $9,400 to run the business, you need to cover this. So this is where capital infusions come in, whether it be credit cards or loans, or personal or private financing, or if this is your startup business, this is coming from your pocket. This is you putting into your business for those months when cash has declined, cash is lower than cash in is lower than the cash out. So if you're looking at this, we see we have 1 month where we're going to need to cover this. So if we're projecting this, so let's say it is January of this year, and we know that this is the flow of how our month, meaning we're assuming or anticipating this is what we're going to be starting with. This is what we anticipate this business to do in terms of bringing in cash. That doesn't mean selling. They may be selling it, but they may not bringing all the cash in because you have receivables. So if we have a shortage of receivables one month, I as the business owner need to look at this and say, I need to have a backup plan for where this cash is going to come from, because starting the next month, I know I'm going to have 5150. That's great. But I need to be able to cover what's going out in the business. So we start bigger and it gets smaller. So that's telling us, this trend isn't attractive. Depends on how this trend continues. If we start with 3,000 and at the end of 4 months, we're left with 1,200, how is this business doing? Is this business growing? Is this just a slow period? That's why I have some of this. Maybe this cash outflow is we're buying a ton of inventory for a big summer season, that we're going to start in Q2. A lot of businesses have very big ebb and flows. If it's a retail business, the holidays are very big. So they may start off January with rich in cash, but they may have lots of months in the beginning of the year where they're not making any. So a cash flow statement helps you to look at this. Now, as I said, this is a very beginning one. So we'll look at some other ones in a moment that are a little more sophisticated. But to talk generically about the cash flow statement, it is your most important cash management tool. So you want to be looking at your cash flow statement, depending on the the variability of your cash and your business and the scale and scope and where it is in its life cycle. You may need to be running this every month and maybe even every couple weeks. You've got to meet that payroll, and I find that business owners that have trouble meeting payroll or they're constantly stressed out about it aren't looking at their cash management as closely as they could. So cash flow statement is a projection of cash in and out of your bank account, not profits. It's very different, the cash that is coming in, because of things like receivables and payables and amortization, those sorts of things. Excuse me one second. Pardon me. I wanted to talk about why creating a cash flow projection. Why is it important? And as we saw in that last example, if you're not anticipating and you're not looking ahead, you may have a shortfall of cash and not even realize it if you weren't projecting it in advance. So it can be an early warning system. It's a really great way of identifying, how is this business doing? Do I need to, if I have a very seasonal business, be holding on to or taking good care of my cash, managing it very tight or closely in months when I'm flush with cash and I don't have a lot of income coming in. So those months when I need to purchase inventory or ramp up for a new season, I have the cash on hand so that I can do that. And it says cyclical businesses need to manage that ebb and flow. Businesses that are very peak season, like the holidays or in the summertime, or there's, tidbits of the year where they may be doing a large event and they need a lot of inventory and then they sell a bunch. It's helpful to be looking at those cash flow projections, especially if you're managing a lot of overhead with employees, overhead like rent, if you have a restaurant or retail store or something like that. Knowing what your overhead is and being able to match it, knowing what your sales need to be in order to have the cash on hand to keep making those payments is important. And if anyone has started a business and grown it quickly, you know that during periods of rapid growth, cash can be your biggest constraint. It's often not that you can't find the people or you don't have demand, but when you find yourself in a business that is taking off, if you don't have an accurate projection of cash, it can hinder you in knowing how to manage it and how to grow it, purchasing more inventory, expanding, things like that. And if you're working with a lender to help grow and expand, being familiar with and comfortable with what your cash position is each month and what you're projecting into the future can help satisfy them so that they know that you know that you're going to have the cash available, to not only repay them, but to cover all of your other obligations. And do you, as we've said, do you have capital or the cash for additional inventory, perhaps more staff in seasonal times or expanded promotional programs? You may be hit with an opportunity to collaborate or partner with, or have a wonderful advertising opportunity. Can you take advantage of that? Will you run out of cash? How does that impact things? Or just future events, whether they be promotional events or events that you want to participate in or put on. And as we said a little earlier, negative cash is a sign there's going to be an opportunity somewhere along the line for getting loans or credit. So you need that buffer. So a negative cash position can signal to you, oof, okay, if I keep managing the business like this, it has a projected growth path, but there are going to be some perhaps periods where I'll need to rely on loans and credit, and the cash flow statement can help you indicate how much that would be. And so how to prepare, it's very similar to preparing an income statement, similar in that you start with pretty much the same chart of accounts, pretty much. You determine your starting cash. Oftentimes it's what's in your bank account, just where are you if you're starting with today, January 1, let's say, of the month. What was the amount of cash in the bank account on the first day? Estimate your cash receipts. So what cash is coming in from various sources. If you just have one source of income, be it online or retail, how much actual cash are you receiving, not anticipating. So some clients, they invoice their clients. So that's not actual cash. That's an invoice. But until the cash comes from the credit card company, comes from the client's check, is wire transferred, however it comes in, it's not accounted for in that month. So you're estimating what would my receipts be. So for example, if you had a business that, I have a client who sells wedding dresses, and she takes a deposit from the bride. When the bride comes in, tries on a dress, she chooses her dress. And in this case, she chooses based upon let's say a template or a sample dress that she wants. My client's shop takes a 50% deposit. So her cash in is 50% of the sale. So it's only 50% of the total dollar of the top line sale is coming in cash. And she may have to pay cash out right then to purchase that dress or purchase that good from the manufacturer. She maybe has it on credit. So maybe her cash outlay in that month isn't actually going out right then. It's only when the dress is perhaps delivered maybe in a month or 2 months. And then the cash leaves the business or leaves the account. So cash in is actual cash coming into the bank account. Step two, we've got two step twos here. Estimate of actual cash expenses. So what are you literally paying out, writing checks to, transferring money to, PayPaling? Who are you sending money out to or anticipate money going out to in that particular month? And then you're left with the ending cash. So in that very early one, we saw very basic, what's our starting cash? How much are we taking in? How much is going out? And then what are we left with? I wanted to show you an example of, as I said, that first one that I showed you was a little simplified. This is a little bit more sophisticated way of looking at a projected cash flow statement. And this comes with some variability. As with most businesses, we don't expect flatline sales every single month. We've got some variability in what this business is selling. This is telling us here in the beginning, what is our cash on hand? And we should be able to see down here at the very end, cash at the end of the month. So during this 12-month period, this business has gone from having $25,000 in cash in managing the business. So it's paying for its goods, it's paying its salaries, it's paying its owner, and it's left with more cash. So this would look just in a quick glance like a business that is viable and has a future, you might say. So a couple of things just to give you an idea of how this works. Looking at this as a more expanded version. So our chart of accounts over here, we have some similar things that we've seen in previous ones. So we have our gross sales. And in this particular example, this business is showing, so for example, this is a paint store, let's say. So they have commercial accounts and residential accounts. And this is how they choose to see it, just because the business owner may want to see these particular categories in terms of cash in, just so they can know, how's this business doing and bringing in cash from these commercial accounts separate from residential, which is often paid for on credit card or cash at the time of sale, whereas commercial could have a lag effect due to credit that they've extended to their businesses. So we have gross sales here. We have cash on hand at the beginning of the month, gross sales of $50,000. We're left with $75,000 at the end of taking in cash in terms of, okay, this is what we had on hand, this is how much we took in. And then this particular business, we're seeing a breakdown of their their different chart of accounts. These are the expenses that they're actually paying cash out for. So they're writing checks or they're transferring money into these accounts. This isn't coming out of debt, or it's not creating debt. It's actual cash that's being written to cover the inventory cost, paying for the rent, writing checks to the insurance company, et cetera, et cetera. So we had 25,000, we added 50,000 to it, we had 75,000, we paid out in cash 36,000. Gives us a net income here. What we're left with is income taxes. They pay it quarterly, so we see how this variability. So in this month, there's no cash going out, even though this business owes income taxes for this amount of money. So this is their net income. They don't pay for that until this third month. So quarterly, they pay out cash for those for the amount that they earned in that quarter. So that's why we see it not every month, but once a quarter. So they're left with a net income. Here we've got the same amount essentially, and then the owner takes his or her cash out looks like consistently each month. And because this is a projection, this owner is projecting that's how much cash that they'll be able to withdraw, assuming this amount of sales and assuming this all comes to pass. So this could be a projection, someone saying, well, maybe I want to incentivize my salespeople so that we hit some new numbers. Maybe these numbers are 20% higher than last year. How does that start to look? If I take out a draw, am I left with more cash on hand because cash is important in the continuing expansion of my business? Could this work? Does this work for me? And in this case, I would say this business has some viable numbers. Some other things we can look at here, as I mentioned earlier, sometimes expenses can hit in particular periods. So for example, here in April, this business may need to do a deposit of $1,000 to hold, for example, a trade show booth, or maybe they did an event in this particular month and it cost them $1,000 to do that, but it's not something that they pay for every month. So maybe this is a deposit and maybe this is the balance on it. So maybe it's a $3,500 event and they go to it in June. Deposit is due here, the balance is due here. That's when the cash goes out, for example. Some of these other ones are more consistent. So you would expect to see a salary to be consistent. You would expect to see, bookkeeping fees and maybe gas would be similar. For example, what we do expect to see some variability in cost is our inventory. So we saw here at top level, our sales are going to vary. And if this business is managing its inventory well, it's only purchasing inventory in advance for those sales. And if we had time to look at this more in depth, you would see it is tracking that way. So this is what a more sophisticated, say, cash flow statement would look like. I want to point you to a great resource. So I hope that was helpful for you, looking at a profit and loss and an income statement. I think a very valuable resource if you're doing this on your own, or you're just trying to make some very beginning budgets and test these numbers out for yourself. You don't have a bookkeeper, you're not working with a CPA yet. Score.org is a great website. And if you go to browse the library, I can't click on this. This is just a picture of their website taken recently. They have templates. So you can download templates. I believe even that you can fill them in online, or you used to be able to fill them in online, but you can get some Excel spreadsheets if you're trying to do a business plan and want to prepare a cash flow statement or income statement. Browse their library, and then there's some other categories. And I think it says downloadable templates is where this comes from. And there's all sorts of great templates, both marketing, finance templates. Score's a really great resource. So I just want to remind you, as a business owner, be asking questions. It's okay not to know at first, but by gosh, get educated. And we do that by learning, by studying, by getting more and more comfortable. And I find that oftentimes people come into the finance world with lots of questions, lots of insecurities and old stories about, I don't know much about numbers, I don't understand this. And the more you can embrace this, the more you can ask questions, the more you can start becoming better educated, both using these, creating them for yourself, working with your accountant or your bookkeeper, asking them questions, the more educated you will be and the more savvy you will be. Just a quick reminder that profit is different from cash. I hope you could see some of that in the terms of the two different statements that you saw today. Profit is the profitability of the business, but cash is literally what's going into the bank account. I encourage you to prepare and review your P&L monthly and create your cash flow projections every 6 months or more often as needed. but at minimum, businesses should be doing them every 6 months, and you can do a 6 or a 12-month. Businesses that have lots of ebb and flow and cash flow may want to do it more frequently, keep tabs on it more frequently, and do longer projections. The further out you project things, however, the less likely those numbers are to be accurate. So only do what you need, but use what is best for you. We here at Mission Community hope that this workshop and this webinar was helpful for you in getting an idea about beginning budgeting, and you learned a lot about both the income statement and the cash flow statement. My name is Polly Mertens, and I'm available. I'm a counselor here at Mission Community. If you'd like to reach me for any private consulting or coaching, this is my information here on the left. Mission Community Services, Chuck Daly is our program director. Wonderful resource. We have lots of people that would be happy to help you through this process. If you want our counselors, you can set up virtual meetings, or we can set up a one-on-one meeting with you to talk about, creating these for yourself. If you have questions, if you're stuck, if you're just starting out, you want to get more familiar, or maybe you've been doing this for years and this was helpful for you, but you want to take it to the next level, please, we'd be happy to help you with that. So with that said, I hope this webinar was very helpful, and we're about to start Q&A.